What's up, party people? You ready to get throw down? Ready to throw down? I am. Let's go. First day today on live stream. We going or just waiting? Never mind. Oh, what up, Bill Fortune? We are going. Have to get my coffee and Celsius situation going on. Takes me a little bit. Sometimes I'm not all fully awake in the morning. Welcome, Bill. Yeah, welcome, man. Welcome to the best experience you'll have in the next 1 minute ever in your entire life. Not guaranteed. No money back. No refunds. Just kidding. Welcome, guys. All right, so we had FOMC yesterday. A lot of stuff we're going to talk about. Pal hinting and the median funds rate looking like it's lower in 2024. If you do the math and the little graphs that you can find from the Fed release, is that we're expecting no more than probably about 1 to 2 rate hikes, and that's it. And we're hitting 0 and we're coming down. We're gonna have rate cuts this year. How about that? Let's see how Wall Street perceives that today, and let's get ready to get going. We also joke around a lot here. Just to be silly. What we're gonna do today, we're gonna accomplish, well, I did that 150k eval thing just to try it out. A group of friends of ours have a business share funding thing. Pass the 150k, boom, got it. Working on 250k, $2,600, $2,800. Wait, hold on, $2,700 away from that, from $15,000. Boom, about to get that. Knock him out, 2 in a row. First real go. Just to show it can be done. Beat challenges. Kind of a fun thing to do. We'll get the news ready. We're getting ready to talk about all the stuff we talked about in the morning. So hang tight. Bill jumped in the extended trial yet? Everybody smash that like button while you're waiting here as well. Jobless claims numbers came in today. We're going to talk about that. That's one of the bigger parts of our thesis here about how the market and inflation control itself. I think the way we're seeing things is that the FOMC is in belief that inflation is going to be under control faster than possible. I figured they would go to at least a rate of 10 or so by the end of next year to really crush inflation against the yields out there. But I guess they see something I don't. All right, let's get ready to roll. Got a lot of stuff to catch up on. First and foremost, we're gonna make sure we don't have catalysts and things we need to talk about. We are up in the upper DD band already on NASDAQ, so we're already opening irrational. Let's get these events here. Let's make sure we don't have any catalyst. That is QQQ or NASDAQ. Yes, really quick. Let's take a look at this. We need to double check right on the way down here. Clearly, we've got some red lines to play with, some anchor points to play with, etc. The reaction FOMC could be its own event, its own catalyst. The FOMC itself was a wash, it wasn't an event. Market price itself ineffectively. We got 25 basis point was the consensus. Fed funds futures, pricing in effectively at, when they were talking about the probabilities, about 85% chance we would get 25 basis points. So we did. Let's see if we can find any IRLs real quick. What's up, y'all? Hey, what's up, Andrew? What up? What up, Lori? Bonnie Tech, Itaidam, Quest. Y'all are always up. Y'all are morning people like me. Y'all are always first ones here. Okay, there is impact. There's run link. Let's go ahead and make sure we mark all of this stuff. Well, the FOMC reaction starts right there. Itai, by the way, dude, I saw your Instagram, man. I like your photography. It's pretty dope. It's like as I'm getting to know you guys outside of trading. You all have cool hobbies and careers. If y'all follow me on Instagram, well, certainly Instagram, Instagram, check you out, see what you guys do. Yeah, man, it's tight. I'm a huge nature hound, man. I love it. Yeah, you know, outdoors and anything like candid shots of nature and stuff. I'm all about that. I'm like a huge peace-seeking human. So FOMC reaction, let's just call it that. So anytime you're irrational outside of DD bands right now, these are upper targets on a breakout to the upside. Make sure that there obviously is no catalyst here, right? But we do have an event. Run length ran out. So let's kind of just mark this here. We're going to repeat the same process on NASDAQ. This is all pre-market check. This is one of Rocket Scooter's calculations. We go and get this done before market starts. We have about 12 minutes to go. I do feel the market's long-minded. I do feel like the information we do have is certainly hinting at rate cuts, right? But also acknowledging that there's problems in the banking sector. You know, this kind of sharp pivot decision coming from the Fed. They're kind of like basically saying, you know, we acknowledge what's going on with the banks, but we kind of don't care. It's kind of not our fault. It has nothing to do with rates, right? That's their thing to say. I mean, it's I would say that's a way to save some face with traders. It certainly is partially responsible, or raising rates partially responsible. Right? It makes it more expensive to obtain credit or borrow money. So clearly, banks' revenues come down. But mostly, it's bad risk management, bad decisions made by risk managers at the 4 banks that failed. So you have to really think about it. That acknowledgement from the Fed to kind of say, you know, 4 banks failed. Well, we don't give a shit. We've got a greater purpose, and that's what we're here for. And their greater purpose is to get get inflation down, right? And so, is inflation still a problem? Kind of. And I'm going to show you why. We had the jobs numbers come in today, and that's going to be the thing we need to worry about because it could grow inflation again. We see the CPI year over year turning down, right? However, we do see a growing deviation in the jobs market, and this is what's going to lead to it. Now, if you guys are here, it's a day trading stream. Obviously, I do a bunch of day trading, but also kind of like to talk about fundamentals and things that we're working on. Let's go right here, FOMC. Let's call it reaction. Let's give it like a little anchor point action here. We're going to do FOMC reaction. So anytime you guys remember from the courses, and we're going to do a lot of zooming today too. So after this, we're going to do some zoom. And we're going to do some teaching. We're going to refilm some of the old courses that we did. If you guys are in the extended trial, check it out. We love y'all to do so. What's up, Karan? Morning. Turn me into a morning person. Got up at 5 a.m. every day because I'm in California. Dude, I know. I feel so bad for you, you know? Those California folks got to wake up and the sun's not even out yet. However, that's always a good feeling to wake up and get your day started while the sun isn't out. That was my grandfather. He would wake up at like 4 in the morning and get his day started. I remember as a kid, and I used to spend at my grandpa's house. It's like 4 or 5 in the morning. I just hear like he's in the garage doing shit. And so I'm like, I guess that's a great way to live, you know, like to just, you know, get your day started before anyone else. You can be so efficient, nobody bothers you. All right, so here we go. We're opening outside DD bands on NASDAQ, slightly irrational. I'm not going to do one on Russell. We're just going to leave these two, NASDAQ and S&P. We have the FOMC reaction IRL there, so clearly red lines and yellow lines are going to be targets on the outside. So obviously, any irrational move to the upside, we're going to look to hit these red line in there. First target is here, second target's there. So blasting through there in case we have an irrational move there. So since we did touch the upper DD band, y'all know the rules. Touching the band with the DD ratio, no longer an idea for today. Let's talk about the numbers that came through here, right? I'm just going to clearly show we were talking about some things. These are first-time unemployment filings, people just getting laid off and then filing unemployment that week. You can see that you had waves of layoffs, and waves of layoffs every quarter. Waves of layoffs. All right, companies laid off some, check their quarterlies. Laid off some more, check their quarterlies, laid off some more, etc. Until everyone's kind of efficient where they want to be. Companies trimming the fat, inefficient labor, expensive people, whatever, that they don't need. And you can see the layoffs are becoming less and less prominent. So you can see that the layoffs are pretty much over. That's what this is telling you already. Number came out today. Every Thursday this comes out, so you need to pay attention to this number. The forecast is more and more people are getting laid off and are coming in way under target. So companies have trimmed the fat as much as they want to at this point, comfortably. So look at this. This is the fundamentals. We're going to teach you a little bit of this here. You see how the waves, the 4 waves you see are less and less and less prominent. That means layoffs are pretty much frozen. So when you lay people off, there's more people that need jobs. Therefore, the supply goes up and wages come down because people are competing with each other for the job. If you have 1 person and 10 jobs available, they can ask for any salary they want. If you have 1 job and 10 people available, well, they got to undercut each other to get the job. So you have the supply and demand balance of available jobs, available workers, cause wages to go up or down, which are the major driving forces of inflation, not rate hikes. It's not going to do much on the surface. It's going to have this roundabout effect. Continuing jobless claims came in today. 1684 came in 1694. More people, even though it came in under red. Oh, okay, yeah, red is bad, I guess, in the unemployment world. Okay, so red came in higher than the forecast. It means there's more and more people not getting their jobs back. These are people that are still filing for unemployment after the first week. And so you can see that it didn't take long for those people that got laid off or filed unemployment to get their jobs back as the continuing claims stayed low. But in the last couple waves of layoffs, we had 4 little humps. Looks like the last 2 sets of humps can't get their jobs back because the continuing claims are still high and flat, which means no more people are getting laid off, which is why this is flat. And these people aren't getting their jobs back. We're talking about, like, I don't know, 500,000 people still sitting there needing their jobs. And we looked at the JOLTS, which have been coming down, which means fewer jobs are available. Companies are eliminating unnecessary jobs. And all JOLTS have been coming up for the last 7 months, which means companies are creating jobs and laying people off, and jobs need to be filled. All of them together paint a really solid picture of what's going on in the market. Lots of people want a job. And we look at the JOLTS, there's lots of jobs available. Well, why can't you match the two? And it's because either A, mismatch of labor type. These people that need jobs probably are tech workers, and the jobs that are available are probably healthcare jobs. Who knows? One of that, or these people, if it's the same industry with labor match, these people want too much money for the job, and the company says, no, we want to pay you less. And they go, well, I have a huge mortgage. I'm a smart person that bought a house at 200% value during COVID, and I need a bigger salary because there's inflation. And the company goes, no, thanks. And they go, come on, please. We need the money. So you have this big disparity between available jobs and workers that need jobs. Not matching up, not getting filled. That's a problem. So it's a big game of chicken. So these people either need to take less of a salary and possibly default on their mortgages, putting banks at risk, or these people need to come get jobs. The companies need to pay more money to get them to meet in the middle. Therefore, quarterlies will come down. Both of those things are perceived bearish in the stock market in the short term. So despite Mr. Man out there talking about we're probably going to start cutting rates this year, as you guys saw, the stock market's not bullish on that note because fundamentally all things are slightly bearish in the short term, right? Do we all see that? I'm not going to lie. I'll be the first one to say I fucking hate fundamentals. I put myself to sleep talking about economics or listening to economics. When I try to talk about it, I try to make it fun, or at least funny, so it's easier to digest. When people talk about macroeconomics, like I couldn't watch, it's just hearing people drone on about economics, even though I love the subject. The way people talk about it just puts me to sleep. I'm homeschooling. You're homeschooling your 7-year-old today. Thanks, Matt. I'll stop cussing so much. Oh, can I show the red line again, please? Oh, yeah. Let's go ahead. Take a look, guys. My bad. My bad, shark. I need to treat this like a family show. You guys got it? 4011 or 4012, 12855. We'll flip to it in a second. You got it? Write it down real quick. I think you can rewind the stream, so go back and look at it. Good morning. Good morning. You got used to it, Quest. Waking up. Can you show the red line, please? Strong disagree in what? I know the industry is going to have another big wave of layoffs. Well, that's what I'm saying. There's one of two things going to happen, right? Layoffs by the data are over. I wasn't postulating anything in the future yet, Brooke Sabbath, so we could be on the same page. I was just reporting the data that is. Layoffs, as of now, are over. So in the future, yeah, it's possible. I don't disagree with you. I think that's possible. As companies are struggling further, layoffs come again. Now, I'll tell you when I got laid off before I turned into a trader, I was a chemical engineer, worked at Dow Chemical. And after the stock market crashed in 2009 and started recovering in 2010, and it was bullish ever since, towards the middle of 2010, after the stock market's been recovering for 6 months, is when they initiated company-wide layoffs. So layoffs, the timing, right, it was, it's hard to say, but I don't disagree. If companies aren't needing people, they're gonna start laying them off. But the data of past history of waves of layoffs have gotten smaller, 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 and there is no current large wave of layoffs, as you can see. You see jolts going up and no new layoffs. It means companies are creating jobs and need people to fill. So it's I think what it is going to be industry specific what's causing those issues. So I do not disagree with you there that other companies will likely come in and have to deal with whatever problems they have. Let's get this here by laying people off. It's 395.50. If y'all hear a cat, let me know, because he is meowing a lot. What's up, Matty B? What's up with COT not updated? For the last 2 months, CFTC has been sending out press releases about that being delayed. And I haven't been reading the last couple of ones, but they haven't been telling us why that's been happening, so we'll have to figure this out. Okay, right out the door, resilience positive. We are sitting near the upper part of the DD band. We are pushing really heavy and hot right out the door on NASDAQ and SP. Let me show you really quick, guys. Top left here, I'm sitting here. We're already irrational on the outside. I need to only trade small. And on the S&P, we are still inside the line here. We're close to the DD band. That's not a lot of room to long. I'm going to get a bounce, bet on a break, and call a day. Something really small. I'm definitely not going to short this. Resilience is nice and strong right out the door. So taking a look at the first two resiliences, 21, 49, nice and strong. You don't want to chase, especially at the upper DD band. I'm going to let it pull back and do something here really quick. All right. I think this isn't market close. Okay, so we're talking about resilience out the door. Type 1 resilience. Oh, and a liquidity pocket. Damn, this is that's such a hard setup to look at. Because it's right at the edge. Okay, let me I think we have the bands are like right here and like right here somewhere. Okay, it's a mean reversion long up. We are random in the middle. I'm gonna let DD be the tiebreaker, of course. Pull the scanner up here. I get some of these guys. Take a look at QQ. So QQQ is there, hitting a random spot. SPY is here. Bull long up. We are trading right here. Possible hedge break, which I do like. Resilience is being nice and strong and positive. Okay, let's take a look. Do I want to chase the long? That's pretty good. Long and strong. Resilience is good. Let me double check this. The upper 4011, there's only about like a 10, 20 point move if we do break a rational upside. We are rational in NASDAQ. Let me take a look at this. I do likely want to grab that first bounce. If we do bounce up at 395, I think I'll take it. What do you guys think? About 20, 25 points to the upside. Now, again, we are sitting on the DD band. So what I don't like about sitting on the DD band is the idea that this is an upper resistance. You're going to have a red line up here as a possible target. Type 2 resilience, really strong, 60%. It's a gap and go. Gap and go with the 10-point stop. So I'm not really too eager about this. DD coming at 0.87. Long and strong in here. I actually do like this. Okay. Let's just play with it. Whatever. This is that eval account. Let me grab like 2. Grab 1 here and what, 395? Dip is about what? 3 points. So here at the 10-point stop, 20-point run, it's about a 2-to-1 trade if I get it. So type 2 resilience, as long as rest stays strong, I'm liking the trade. Even though we're irrational, I got to trade kind of small on this one. So right off a hedge pressure, I'm going to go. Again, everything's random and chill here, but I'm going to take a discretionary trade myself. And this band is actually right here. All right. Let's make sure res stays strong and positive here. Right off the band. Let's take a look. It's random from the middle, wall to middle. I can take the type 2 resilience trade. As long as res doesn't tank below 0 and we get a little bounce there, I'm good. If we tank below 0, then it's a cut. I'll just take a 2 contract trade. Again, the upper resistance here is, this is now, again, a tricky one for me. So I'm going to just keep it small. That did fill the gap. So NASDAQ ran and hit the top. ES is near the top. So we are trading off of yellow. And the question is, do we go irrational or not? Support on bull zone, accurate. Which is about right here. To complete the same thing NASDAQ did, but think on the ES. So about right here to about right there. It's about a 20-point, give or take. And we'll see if we get it. So you can keep res nice and strong here. Okay. So liquidity pocket, markets are random, always trade small. Right? Your cat's in their regards. Aw. So not a lot of upward movement because we are DD band, obviously limited. So this is kind of like really hard to say. Do I want to bet that it goes irrational? Resilience is long and strong, and we do have that type 2 resilience kind of sitting there. So I'll have to see. It's good. Type 2 resilience, looking solid, looking strong. Aren't you always just go long at the open every day, scalp few bucks, call a day? Yeah, pretty much. Well, not go long, but I do what the market says. The market's been going long every day. I don't know. I haven't lost a trading day in like 3 weeks, though. Just analyze it strong out the door. Wrong side of the trade. Am I on the wrong side of the trade? Oh, no. Random stranger? Tell me how. I want to learn from you. Let's go ahead and see what we have. Illiquidity pockets. Take a look at the scanner. Pop up some illiquidity pockets right here and see if we have anything here. That's worth looking at. Distance from hedge pressure. Let's actually illiquidity pockets and hedge breaks in general. How about M? I'm just looking at the scanner. I have this hedge pressure break there. ConocoPhillips, illiquidity pocket, hedge pressure breaks. Oil and gas moving. I think their arguments for this is they're probably also like a gave them a different click. Yeah, or they're like a trading guru or something. Here taking notes, wondering how our stream got so big and theirs didn't. Oof. 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 Everybody smash that like button real quick. Let's see if we can't get some love, some algorithmic love here. You know that trial with Zach Morris and all those guys is literally, I could walk to the courthouse where I live. They are so close to where I am because I could throw a rock from the roof of my house. I live in one of those 4-story houses, big tall house. And I have this balcony on the top, on the roof. I could sit there and literally, and I'm joking, I can't throw a rock in his skyscraper, but it looks like you can. Like I literally am, I look up and there's skyscrapers like right there. I'm right on the edge of downtown. So I can literally walk to the courthouse, catch a glimpse of the famous trial if I wanted to. This is Zach Morris. Like, I was, when that stuff was going on, I told myself, there's no way people can be that just like spit in the face of the SEC and not care. I was like, are they like CIA project to scare all the other pump and dumps that they're really just like actors? There's no way people be that obvious and like, LOL, bro. Look, SEC, here's my Rolex. Like, go ahead, come arrest us. It was like, okay, there's no way people are that dumb. But I don't know, maybe it was like to create a show and show that you get pinched and they're going to get in the witness protection and disappear because they're like a CIA project. I was like, who in there? They got to be doing this, got to be staged. There's no way there are guys out there really pumping it up in these stocks and be like, no, they're real people. They really did this. They're just dumb. I was like, oh, okay. When I first heard about it, not now. No, now it's definitely, I know, like now it's real. When I first heard about it, oh yeah, this guy's posted pictures of jet skis. I'm like, does he work for the government or something? Like, or we could ever do, possibly. But resilience is still positive, so type 2 resilience is still strong. ConocoPhillips, I'm looking for hedge breaks to the upside in illiquidity pockets. So let's look at monthly hedge breaks to the upside as well. Illiquidity pockets, Las Vegas Sands. I'm just looking for runners and squeezers that can possibly move. Again, it's a rough trade at the top. Sitting here. Illiquid pocket there. Okay. Just seeing what we have. Let me put S&P right up in front. Again, resilience is still good. Not really too worried about it. But, like I said, there's that hedge pressure tap. Oh, I got 3. Man, I just wanted to get resilience positive. Type 2 resilience. Let's go. Let's add one more. Again, irrational, but do we move? Yeah, I think it's a gap and go. Res is strong, DD is strong, supporting at bull zone. That's all good and all check. I don't not like it. What do you guys think? Looks clean. I like it. After yesterday's FOMC, you will see sell-off no matter what those magic charts say. Oh, these aren't magic charts though. These aren't magic charts. These are positions in Wall Street. This is where people are positioned despite what anyone says. So this is like where everybody else in Wall Street has their positions. Either case, yeah, yesterday the market reacted as we talked about this morning. Fundamentally, the stagnation of people needing jobs and jobs need to be filled is causing a little bit of bearish sentiment. Companies that have to pay more for the workers that aren't filling the jobs, or the workers that can't go back to work are not producing something, and also they're at risk of default on their mortgages. and other things that they need jobs to pay their bills with. So the idea that people are sitting there unemployed is less production, higher risk on credit, bigger risk on banks. That's bearish for the market. Or companies that are going to have to pay a little bit more to get those people in the jobs because the JOLTS say they're job openings. Companies can't find the workers, and there's a huge saturated labor pool that people need jobs. Companies don't want to hire them. So they want too much money for their job. So companies want to pay less, but now they're going to have to pay a little more to get people in the jobs they need filled, which means companies' bottom line is going to come down a little bit, which is also bearish in the short term. So that's why we sold off yesterday. Any questions about that? Yeah, we know. We had a whole 10-minute speech about it. The reaction was bearish, even though the median funds rate in 20, let's talk about it. I know I'm right on the trade. This is 0% chance that I'm gonna lose this trade today. Oh, as I said that, let me just kind of, Jesus Christ. Can you, universe, can you let me finish my fucking sentence before I say something? Okay, God, they took my win out. I was gonna say, all right, in the middle of me saying, I'm not gonna lose this. Can you like, can you let me do it for the show, universe? Jesus Christ. Oh my God, universe, didn't give me a chance to fucking brag about being right for I'm right. Whatever. All right, I'll take it. Whatever. Your manifest. Can you let me finish my sentence, please? For the love of God, I hate being wrong though. Really, just. All right, I'll take it. Yo, what up, Tommy? How you been, dude? We gotta hang out, man. It's been a while. I gotta introduce you to some other Houston boys, dude. There's a lot of people in our stream that are from Houston. So again, I'm trying to get 265. 15,000 profit is to win this what do they call it? This eval thing. I'm at $800 away. What was I gonna say? Market show no more. H-Town. Who's H-Town in the house? Brian. Yeah, Brian, you like my boy Tommy. He's cool. Or blast up the bulls up. No, what I'm looking for is right here. I'm looking to just fill this up right here. This gap. I'm saying this reaction gray line. So yeah, while I do agree that fundamentally the markets are going in a certain direction, I can't disagree with you there, buddy. But like the idea comes down to markets don't just go straight down. As a matter of fact, in a bear market, if you go to our candle count class, which is a really cool class on bear markets. In a bear market, you have one green day for every red day. If you count the last 2 years of bear market candle data, you will see that. Doesn't mean the market doesn't just fall straight down. Like I trade what is and what I can see. This is really easy, obvious trade right here. Resilience being greater than 0. That white line is support. I buy right at the right line. Got him pretty good. My small challenge account, the 10K to 100K, people still ask what happened to that one. Weren't you? Well, it's at $23,000 right now from 10,000 start. I'm gonna hit 100K on that account probably in a month. So hang tight on that guy while I show my stats and trades on that one. Yeah. But anyways, I made a pact of the trading. No, I didn't. I did not sell my soul to anything. Probably to you guys. Y'all own me pretty much. Because I'm always here. Shifty Rock Scooter's been helping your trading. How so? Are you like thinking better, risk management better? What are you doing what are you in your mind doing that's different that you like? I guess I'll just take the $1,000, whatever. Just try. I know it likely goes a little bit higher. Watching resilience going higher. Resilience is good, nice and strong here. I do like what I see. I'm not too scared of this. VIX is about to push to triple B. Let's talk about this really quick. Again, VIX sitting at triple B, almost there. That's likely going to create some volatility. So I know some turbulence. Remember, if you ever go to we talk about the triple B, we can do that class today, right? So when this guy approaches here, volatility can enter the picture. So be very careful on a triple B. This can just completely decay out and we got a nice bullish month in front of us. But when we get here, but understand that volatility is likely to be here. So it'd be nice to see the market just and then start to get volatile. And then who cares what happens from there, right? And go back to my main thing. So Mr. Person who was saying I'm on the wrong side of the trade, this and that, possibly. But it's not about picking direction. It's about trading like a market maker. You're gonna look for buyers, look for sellers. That's the whole point. Get in, get out, trade something that you see that makes sense. And it's not to guess that we're going to be bullish. It's to trade to a certain level. So all we do here is we can isolate where high volume pivots are. Support and resistance. Not that hard to find. And I trade from one resistance to the other. Right out the door, I can find a really strong trade based on what I have, the evidence in front of me. We draw it out for y'all real quick, right? And this is how it works, Rocket Scooter. So if you guys have been using Rocket Scooter, the extended trial, please let me know. I'd love to hear some honest reviews of what y'all are experiencing. And I'll tell you something. This right here is gonna give you a $35 a month membership with the subscription for 3 months. It's normally $199. Okay, it's like our full unlock, all your data feeds, options data, stock data, all that stuff. And we're opening up the doors, what we call the extended trial, so people will check it out, actually go through our entire training program. And if you want to stay, stay. If you don't want to stay, you don't have to stay. And it's been crazy. We get like 10 to 20 people sign up a day. We're growing so fast. It's insane, which is cool, which means we're always training, always teaching. We'll be the price of 3 months trial. Let me just tell you, it'll be worth your time. Everybody that's in the extended trial, we're gonna give this first batch of people. Y'all want to see? I'm not gonna lie. Look how many of you guys have come through. 1,500 people in the last 3 months. We used to get about 500 or so a month. Literally, I hate to use the word viral, but y'all are awesome. Y'all really, we're about to go on a hiring spree. I mean, it's crazy. It's cool. And it's insane. We've had 1,500 people come through the ranks since the merger. Come on, keep going. And the thing is that we just want to teach people with very inexpensive. We'll give you some risk management tricks, right? Rocket Scooter, you can use it, not use it. Trust me when I say if you stay until the end of the extended trial, you're going to get a discount. Whatever, let's just finish this today. Let's just buy one. If I need 800, let me just get one contract. I do want to finish this today and hit that 265. Whatever, let's just chase it. Let's knock it out real quick. So if you were in the first batch of extended trial, like these first, 1,500 people that have signed up or whatever, what we're going to do is it will be 100% worth it to stay to the end. It's like that grandfathered in gym membership. You guys won't get anywhere close to $199, I promise. Y'all can lock in a really kick-ass rate. Everybody. We're about to surprise everybody in Rocket Scooter with the kick-ass rate. And then it's gonna go back to normal price. Andrew, Triple B, 2217. Let me write it down so that you don't have to wait for me to say it again. That's a Triple B though. Invex. So what we teach is risk management. Yo, what'd you miss? What's up, Ashton? Everybody say hello. Mr. Ashton Nolan gracing us with his presence here. Dude, your courses, man, I knew I picked the right guy. He's coming here and start teaching me some stuff. Shit, dude. Literally blowing me away with the amount of knowledge. I mean, I know you know a lot. I've known you for a long time, but Jesus Christ, man. I'll watch your stuff and I'm just, my jaw's on the floor. I'm like, I need to learn all this stuff. You're a great teacher, man. Fire, dude. 100%. Yeah. You've been signed about a week. Take a lot, especially having a day job and loving it so far. I know it kind of is like, that's the hard part about trading and having a job is commitment to the time. So what we're actually trying to do, and Ash and I are trying to like make it to where we can have courses that are easily digestible, like the quick path or the summary videos. And we're actually making some infographics. So we have people from the team that have been volunteering, like Amarath and I'm not gonna spoil the surprise, but whatever, I'll spoil the surprise. We're making you guys cool things. Like we're making a book, like literally you can print out a book with all the different tools. This is my notes, but basically to show you each of the irrational rules in an infographic. Just so you can, like, essentially flashcards. We're a big fan of flashcards here, as y'all know. So y'all can thank Amarath. He's putting a lot of time and effort into making these drawings for us. We like little flashcards, little handouts. I'm actually revamping the liquidity map drawing to look a little bit more specific to the colors and the scheme that you have here, color scheme here. A little easier to follow. But yeah, so we're going to give you like an entire playbook, literally to print out. So one of the things we're doing, to try to make it to learn as quick as possible. The idea is that you can learn risk management principles with or without Rocket Scooter. If you guys stick around, clearly you'll get a cheaper subscription if you stay till the end. We promise. That's the whole goal. If you stick around till there, you can use our platform forever and ever. You'll get a pretty decent rate on that. But also, you'll just learn. You knew you love it. Wish the classes were shorter. Well, we are making shorter classes. I know. Part of the classes being long, and what we're gonna do is we're gonna refilm like a shorter version of the classes. Is that we did this like immediate rush boot camp when people came in. We just like jumped them into it. It's to shape you, to make you think, to change how you think about the markets, to think like risk management, to think about like a risk manager. These are the things that we really spend a lot of time thinking about. Is not just here's how you use the tools, have fun. It's like boot camp. Like you come in here, and we actually call it cadet camp or cadet boot camp. You come in here and you actually get trained on how to be afraid of irrational markets, right? How to be confident when markets are a certain way. Markets are irrational right now, and I'm confident on my trade. Like the feeling is there, like I've ingrained it in my brain that I like what I see. And like the idea is to train you guys in helping with problems you face as a trader. Over trading, fear of missing out, trading too much. I spend most of my trades take place. Now again, I could be wrong on this trade, who knows? But most of my trades, I'm done within an hour. I just get in and I get out, and I don't sit there and gamble all day long. I've learned, you know, obviously in developing a trading platform, there's a lot of time commitment required of me. So what I've always learned over the years is that I try to find that one big trade that works really well right out the door, the one that makes sense, and I try to take it. Call it a day. Can I explain more about the training program? Is 100%. So for you, Daniel, just to answer your question, the training program it exists in. Go to the curriculum really quick. And I have a bunch of people messaging me, so I'll get you in a second. Hold on, let me. Oh no, here I am thinking I had my development window open. Well, if you guys want to read Rock's your development chat, by all means, but top secret hedge pressure calculations are in there. Just kidding. Okay, structure of the courses. If you guys go to our Discord, you'll see it like this. It's taught in a certain way. So as soon as you join, it says read first curriculum. We go through and teach you how the courses work. There's a quick path, a total immersion, and a summary. The summary is like a 5-minute video that explains what the course is and what it is, and basically the rule. Like, here's the irrational rule, how it works, goodbye. Quick path is like a 15 to 30-minute video on each topic. So what are our topics? If you go down to the bottom, there's software help desk, bots and indicators. Actually, no, it's here. The rocket scooter overview. This is everything. This is everything at a glance. We created 15 different tools, and none of them are technical analysis. They're not trend-based indicators. They're not using price action, any of that stuff. We completely created a brand new style of analysis. First time in half a century this has happened. People use fundamentals, which is macro and microeconomics, to look at the health of the company or health of the economy. Technicals are looking at past price data, price and time, to try to forecast future price changes. So price is an input, potential price is an output. We don't do any of that. Our inputs are information from the options world, risk and hedging algorithms, things that we put in, mostly options information. And the output is we predict where volume will be at a price. We predict where volume will be. We don't predict price action. It's impossible to do that. Find yourself your favorite technical analysis program and watch those people trade their accounts up and down and up and down. It's all chasing the market, delayed signals. You can't predict the stock market. So our thesis was that you cannot predict price action in the stock market with past price history. It's impossible. Technical analysis falls on its face. It fails out the door. By design, past price action has nothing to do with future behavior. Zero. You can't do it. So we started something new, is that we created a program that uses very sophisticated exploits to try to find high volume at a price. So independent of time, independent of candle charts, there's no multi-time frame confluence, none of that. I always trade on, I always have like a 1-minute chart on. I never have to look at weekly, daily, whatever. So no more time changing on the charts. No more technical analysis, no more delayed signals. I just know where volume will be. That's it. There's 15 different indications that predict volume. The ones that are the most severe, volume can be so crazy and we predict where volume will break out and be crazy. I'll show you some of them. We call it irrational market. Irrational markets just create random behavior. We predict where margin calls will be. We're looking at positional data. So predicting where margin calls will be is a big deal, because I know where the markets are going to run away and be random, and I don't want to be on the wrong side of it. These are usual markets, high volume that create turbulence, and then these are our pivot equations. The main three are called DD, resilience, and liquidity map. So 3 of those together are my entries. You saw me make an entry on all 3 of them today. Rational, irrational, adjust my position size. I'm right close to that red line. Let's go, baby. Come on. And that's it. So each of the courses go through these sections: risk management, trade plan, entries. And so we break it down into essentially a risk management course. The risk management course is going to go through each of the 5 irrational signals: 1, 2, 3, 4, and 5. And what irrational does is tell me to sit out if markets are crazy, or bet small if markets are crazy. Oh shit, I'm about to get it. Let's go, baby. Come on. Come on. Come to daddy. Give me 17 more bucks. Let's go. Come on. Let's go. Come on. Done. Pass the 250 eval. Fuck. I didn't even lose a day. Pats on backs. This is Rockets in chat, you guys. Let's go. Let's go. Let's go. Let me close everything out. Done and done. Not bad, not bad. Get some rockets, chat, you guys. Here's the that's the 10K to 100K challenge account right there. Oh, that was fun. That eval thing was fun. I'm not going to trade these accounts. I just wanted to pass them just to pass the challenge. This was just me doing it for fun. So my 10K to 100K account is now a quarter of the way there. So I'm up to 24,000. I made 2,500 bucks on that account today. Done. And here's a retapped. Look at that, guys. Do your homework in the morning. Do your red lines. When you're outside a DD band, red line is a target. Do a class on this today. But I continue to trade futures right in these sessions. Are you talking about me? What do you mean continue to trade? Like after I close out, usually I get my career trade and I'm done. Jason reminds me about the housing numbers. Yeah, that's correct. We can talk about it in a second. Just going through is that we have like, if you wanted just the summary and quick path, it's like a 30-minute view. Let me go back to my main screen here of each class. So the irrational rules are like, okay, market's irrational. I'm going to trade small or bet small. But we teach you risk management right out the door. And I know it's grueling, but risk management makes all the decision in the world. Have you ever had your trading platform turn off your moving averages? Like, hey, don't use them today. They're completely garbage. It doesn't, right? That's the flaw of technical analysis. They're always trying to produce signals. You watch anybody that does technical analysis, they only like to draw a box and show you when their winning trades are. They'll never zoom out. They'll never show you a history of their account. Point number one, anybody uses technical analysis or tries to sell you some kind of like technical analysis based algorithm, quote unquote, which I find that be a ridiculous thing to call it. Algorithms make decisions, right? And if you're just constantly printing math, there's no decision made. It's a dumb indicator. A smart indicator is one that chooses to make the decision to show you an indication. So irrational is the precursor to Rocket Scooter being the first platform in the world that you can create trading rules in, and that we already have the pieces here. Imagine that irrational rule flags, and I tell myself, I created a rule that says when the irrational rule flags, don't use the scanner. Okay. I could create a rule for myself that says that. It'll come in the alerts, and we're gonna have a thing called rule assist, and that's really the big thing. Imagine that you run a trading community and you created some trading rules, right? And you want to teach your rules to people. Like, I only trade when these averages cross over. I only trade when this happens or that happens. When those things don't happen, I sit out. You can program that as rules. You can create alerts for your rules, and then you can also tell the trading platform, as you program your rules, to tell it to turn off everything that you would use, physically remove them from the chart. That's a real algorithm, choosing based on a rule to not let you see the levels you would normally trade at. If my rule is when irrational, don't trade, I'd come here and my liquidity map will disappear because I told it to when I was sober. And now I don't have my stuff, and it reminds me, oh, and I look down here, oh, the lights are red. Oh, that's why. And I told it turn it off when the lights are red. And if I go over here and try to turn it back on, like a pop-up will come up and say, are you sure you want to turn that back on? You told me when irrational, we're turning this stuff off. So rule assist mode is the big thing Rocket Scooter's been building. We're the first platform in the world to do something like that. So the idea is that you'll be able to program rules and share your rules with other traders very easily. You want to download my rule set that says turn off your indicators and all the 5 irrational rules trigger, then I'll export it and you can upload it to your thing. Automate the whole process. So in the meantime, we teach you how it works. Like, well, how my trading style works. But my trading style is not what Rocket Scooter is selling. I mean, you'll learn my trading style as a teacher here. You'll learn Ashton's trading style as a teacher here. You'll be able to learn anybody's trading style. Rocket Scooter will be a universal platform for that. So my risk management rules are programmed in here. I train you on each one of them and how to handle it, or how I handle it. Either sit out or trade small. One of them, the VIX risk interval rules, sit out no matter what. The VXY one is the mild one that says, yeah, you can still trade, but watch out, it's going to get wider. So we learn risk management out the door, when not to trade. Entries, where to put an entry. There's three different tools that are the major tools. There's just called the big three. Liquidity map, CD, and resilience are big three indications. So when not to trade, where to enter a trade, where to exit a trade. So the three of these things, should I trade? Okay, where do I get in? Okay, where do I get out? 1 through 3, now you can calculate risk and reward for every trade. What did I say my trade was today, guys? If you remember from this morning, tell me. I'm out the door. The first thing I said was my trade is this, 2 to 1, right? How'd I know that? This is 1 through 3. You'll learn all these in the process. So it's not a lot of stuff. It's just, it's really risk management heavy at the start. But hey, you know what? Trading is all about risk management. Trade plans is a way of putting it all together. Clever ways to do trade plans today is going to be part of the trade plan series. Trade styles focuses on like options and futures. So we go into option specific futures. We're filming these right now. How to get funded, tricks of beating evaluation, candle count tricks. I talk about how I beat these funded account programs right out the door. I have a trick for each one of them. I create a unique trading style based on the rules of these funding programs. I'm going to do a challenge this year where I'm going to beat any trading. If anybody gives me a challenge for trader funding, I will walk in and I will crush it. No offense to how hard they are. I'm very good at rule-based trading. I follow my own rules. I get there quickly, or I get there safely, not quickly, and I make a rule-based setting. So this is teaching how like future-specific position sizing classes. Ashton's teaching options. So trade styles will branch into options, option selling, options buying, different styles based on futures, stocks, options, swing trading, day trading. You'll kind of branch into a little more specifics, as these are universal ways to find pivots in a day. Fundamentals is fundamentals, and basically that's it. You will learn every part of how I trade and Ashton trades in our curriculum. It's $35 a month for 3 months. And then afterwards, I promise you, we're gonna give you guys all a discount. Everybody's getting a massive discount at Rocket Scooter. Only for this first wave. The extended trial program is likely gonna go away at a certain point. This is just to get y'all in, to check it out while we're building it. Well, that's what you guys are saying. All right, so let's look at this. If you're long in hedge pressures, our strategy is to hold the top of the bull zone. Angelino, let me teach you about my strategy here. The top of the zones don't have, it's not the top of the bull, well, not the way I teach. So I know Ashton has a way to teach. He trades within the bull zone. My style is different. So if you want to learn about my style, I don't trade to the top of the bull zone on a long. I don't short to the bottom of bull zone on a short. I trade to the next resistance. I have a bunch of ways to determine the next resistance. Let me show you how I do it. Great question, though. The session from Tuesday has not been posted in Discord. Was awesome class. I will think about posting that one. I forgot. Yeah, okay. So there are my exit rules, right? My style exit rules. First and foremost, gap fills. Right? We need to make sure we always monitor. And again, I know it's a little messy here on the chart, but I'm always going to monitor my gap fills. You see right here, right? We obviously traded down and gapped up today. So I need to put a line at the close of yesterday. So I look for gap fills in the vicinity. Gap fills are always a resistance. Filling a gap is always a resistance. Okay. So where's that line that I drew right here? Clearly it's going to be on the close of yesterday. Okay. So anytime the market's trading in a direction, filling gaps are grander targets. So I'm going to go ahead and remember that I have a bunch of places that the market can fill. I personally like to always trade to the next resistance that I find in a day trade. So what I call my career trade is trading from the first support to the next resistance, okay? So of all the rules you look for, I'm just going to write them here. We have gap fills on the daily chart. That's an exit target. When inside the DD bands, so this is typically outside DD bands. And this is the green bands. So I'm going to write this right here, DD. This is one of the first classes you take is DD, these green bands. Outside DD bands, I like to do gap fills, red line, yellow line, which is what today was. inside DD band. Specifically. DD band itself is an exit. Non-specific, like non-specific. It's irrational or irrational. It's for opposing walls. So in the bull zone, I like to add a bear zone wall, if there is one, which is called the other side of an illiquidity pocket, right? Or liquidity pocket. You may have just noticed, if y'all are in the classes, that this is basically LPIP. And then, of course, if all else fails, I'm out at 1400 hours. So I got 1, 2, 3, 4, 5, 6 rules. Always. To get out of a trade. So I find the first entry, which is using the big 3. 1, 2, 3. And I exit my bigger part of my position at any one of these 6 things I look at. These are all resistances. So I can narrow it down. Well, there's no gap fill. It's really far away. The DD band was really short. That would have been that one, right? That's this guy. So the R&R on that one wasn't that great. So I'm like, okay, I'm going to choose to put a 10-point stop, and I'm going to try to get the next target. There was a red line that was exactly right there. We showed you guys that in features. So no gap fill. There was a red line in the vicinity, DD band in the vicinity. Opposing walls, well, bull zone, opposing wall would be bear zone. That's further away. Liquidity pocket, there isn't one. And then 1400, well, that's far away. So in reality, I know I'm looking for either a bear wall or a red line, whichever's first. Oh, there's the red line. So I take the first resistance, and that's my career trade. My first big trade I take. I call it the career trade. So career trade is get in, get out. And then you're not in the market for sudden catalysts. You're not in the market for crazy events. You're just in, you're out. Oops, why did I? Just grab the screen here. Let's not do that. Okay. Any questions so far? Learned a lot from the shorter videos, though. Yeah, we're going to keep making them shorter. Hey, Matt, the session Tuesday, blah, blah. What do you think? Why do you look at SPY options of ES futures options? SPY has more data. Brian Davila, yes, that's actually correct. But also, another major reason that we look at SPY options instead of futures options, it's so much more liquid. There's so much more data, better data points. Yes. One could formulate a liquidity map technically out of SPX, which has a liquid options chain, and one could formulate a liquidity map, which I'll go over the 3 right now, in S&P futures options. The thing is that the trick that makes liquidity maps work is the way the options are handled. There's a reason we do it in SPY. That is part of the secret sauce. If I long SPY, me, trader, then somebody has to short SPY to me. And for the sake of the argument, remember, shares of SPY. We'll say it was a market maker. I bought like a whole bunch of this, right? I bought 100,000 shares. So market maker shorted 100,000 shares. Say they shorted, but they want to be able to immediately cover at the same price at no loss. So they short 100 shares, but they bought 1,000 calls, right, at the same price. So they're short, but they can buy at the same price, the same amount, so that they have no risk on that trade, right? First and foremost, Rocket Scooter looks for that, which implies that. We know where your bull is when we find the market maker options. We look at the options order flow, and we derive just market makers from that in a way we know they're supposed to behave. Okay, market maker 2, this is the trick. Had to sell those options to market maker 1. Had to sell 1,000 calls. So if the calls were right here, and the calls go in the money, market maker 2 must long SPY, because the calls are at exposure at being assigned. Somebody has a right to buy the shares from them. Well, they need those shares. They got to go fish them from the market. And if those calls go out of the money, then market maker 2 will, they don't have to, but they will sell shares, SPY, at a rate of delta, to match the risk of their exposure. If the calls are out of the money, they're going to have no exposure or just delta exposure. So in this particular mode, somebody longs some shares, market maker shorted to you, bought some calls. This guy sold those calls. And this guy is now buying and selling to the market based on those calls going in and out of the money. Well, if the calls go out of the money, then he is selling shares of SPY when you bought shares of SPY. And now a trader has found a counterpart to their trade, and the person inside the box has done their job of matching buyer to seller. Buyer and seller match. Liquidity provider finds a buyer, finds a seller. This person's going to maneuver the price around to force this person to buy and sell stocks against real traders, while they're always balancing their risk to zero. And so because SPY loops all the way back around on itself, this is a very robust analysis method to use share settled options. The reason we don't use futures options, all of them are in the Rocket Scooter training S. The reason we don't use futures options is because futures options settle in futures contracts. One futures call settles in one futures contract. And somebody that's hedging futures can hedge futures any way they want. They can hedge futures with, let's reverse. Imagine it's oil. I'm using oil call, like I bought a whole bunch of contracts of oil and someone sold that to me and bought an oil call, which is really not what's happening, a CL call. And so those calls go in or out of the money. You would think that they come back and buy oil contracts to hedge, but they can also go out and buy barrels of oil to hedge. The fact that commodities contracts settle in physical commodities means that the hedging can be done away from the stock market and the futures market. You don't see it. Does everyone understand that? If I have shorted 10 oil contracts, those oil contracts go out of the money, I can, and what am I going to do? Short, or if I sold oil options and those options go out of the money, am I going to short oil contracts? No. What if I have an oil field? I just owe somebody 10,000 barrels of oil, right? So the fact that I can do my hedging with my own inventory of a physical commodity means a lot of that hedging escapes the visibility of traders in the futures market. Because of that, it's not as strong. You can't go out there and you don't have SPY sitting in your backyard, right? You can't hedge with it. A SPY isn't a thing. It's a basket of stocks. You must hedge internally to the stock market. Now, some of that hedging escapes via dark pools, but we get that data when it's reported to operate in the middle of the night. So because SPY internally hedges against itself with SPY, then it's the strongest liquidity map. Isn't that cool? So people ask, why don't you use SPX? Well, SPX is a cash settled instrument. You can't hedge SPX options by buying SPX. What do you think they buy to hedge SPX options? If you bought 1,000 calls of SPX and they go in the money, what do you think those call sellers are out there buying. They're buying SPY on top of that. It's the only thing you can hedge the entire SPX with that is a share of something or cash. Either way, it's all internal in the stock market. So SPX is still not strong because they're going to be trading SPY or cash or any of the other ETFs that they want. But since SPY and SPY options settle in SPY shares, the hedging's done in SPY, it's all looping back on itself so that that circle, it's internal. And it doesn't escape the visibility, so it's a stronger liquidity map. Isn't that cool, right? So people say, like, why do you pick UVXY over VIX? It's the same thing. It's shares that are hedged in the same shares. Buyers and sellers match each other. It's all captured internal without escaping the visibility. It's pretty cool, right? So you think we put all of our thoughts in this? This is a great question. Why do I look at SPY and pivot the futures? Well, I look at simultaneously SPY and futures at the same time. Let me show you guys that. Today's trade was a long off a hedge pressure on a BLU, right? I go in here, I'm gonna draw all the things. So once I determine rational, irrational, let's just say that we'll skip that part now. This is how I made my trade today. I'm gonna say market opens, which is that black dot. BLU, right? This one right here. Blue is blue, right? This blue line is that blue line. Market opens here. And if it falls to blue, and if I'm a bull, then I would like to long it blue back to the open. It's a V-shaped trade. Here, here, there. That's it. This says if you support above the open. I'm sorry. Let me start over. I do that wrong. That's not where we opened. I think it's all delayed here. Okay. We opened right here. So open, blue, bounce to open. Well, it's right there. There's nowhere to go. It's literally like super small. But if you support at the open, then it trades to next resistance. And I like to look at that. Okay, so I'm just going to draw a line that says to the next resistance. Actually, let's draw like this. So this is 1A from the liquidity map, next resistance. Okay. This being greater than half, or greater than 6 if you want some fat on it for irrational, just means we're supporting here. The bull zone. Very high probability. What's the stats on that, guys? Y'all remember? Backtest stats support the bull zone. Very high probability of that. Your eval platform froze up 3 times with open position today. The fact that you didn't have a heart attack is 100% thanks to Rocket Scooter Jason. Saving lives. Bro, I love you, man. Dude, these eval companies use like third-party data feeds. So a lot, I've noticed they freeze up a lot. That's not the eval company's fault. That's the data providers. Which is use Apex, which is with I've never used Apex, so Rhythmic. Rhythmic is notorious for having data feeds lock up, but that's again data provider. Our data feeds with Rocket Scooter from our options data provider locks up too. Not a bad thing. It's just, you know, as more and more traders go, infrastructure just can become buggier, need expansion. You know, I run a tech company in the financial space. I understand their pain. So it happens. You just have to be careful when that happens. Yeah, the very first day I tried to run these evals just to see if I could pass them. Trade of 8 locked up. Their data feeds froze, and then the market, it wouldn't let me trade. It wouldn't let me see the data. Nothing happened. It was crazy. The only prop firms I've used so far is to try ETF. That's it. The only ones I did. I've never used a prop firm. I actually never paper traded a day in my life that I can remember. This is the first time I ever did something like this. And I did it just to kind of show off, you know, this company. These guys are pretty cool. We, you know, obviously, the reason I like to do these things is because number one is I'm teaching courses, right? As an educator, I'm going to teach courses on how to pass an eval, how to have risk management, how to manage your trades. So I have to go through it myself. They had an affiliate program that's like, we'll pay you for referrals. I said, nope, I don't want to get paid. I don't want to do it. I want to teach a class on how to beat an eval. So it means I have to do it myself. I have to really do it. I can't just practice do it or fake do it. I got to really do it. How am I going to teach a class in it if I've never done it? You know, I think their program also lets you get like, or they like skip their affiliates maybe to the funded stage. And I said, I don't want any of that. No handouts. I want to do it from square one, like a human would do it. I love an ultra hard challenge. It has drawdown restrictions, and I want to show that you can beat it. Using risk management principles, taught a rocket scooter. I don't need a funded account. I'm gonna split my profits with another trading company. You kidding me? I make a fuck ton of money as a trader. I want to show that I can beat the system. That's my power. That's why I want to do it. So as I pass both of these, I'm not going to trade out of either of these accounts. I don't want them. I don't need it. I just sent a message to them. I said, hey, I beat the 2 evals. Close it down. That's my integrity as a trader. I don't need a handed out account. I need a funded account. None of that stuff. Can you trade rocket scooter in the future? Yeah. You'll be able to trade in the future, 100%. We're going to have futures opening up. We're working on that right now. 96%. Yeah, true. Okay, so anyways, back to what I'm saying. Bull long up, next resistance. Support, DD is greater than here. And resilience was above 0, so we supported the white line on resilience, right? All things pointed up is a gap and go. The first thing I said at the stream was it's a gap and go. Right? Res type 2. So I needed to go find my next resistance, and outside the DD bands, as we said, we always go look for red lines and yellow lines. So I said, all right, I got a support right here at the bull zone. That's about a 10-point support or a 10-point stop. And I'm going to go up here. I could say, where's my next run? Oh, okay. It goes right to the red line, the reaction line. It did that pre-market. So if you see, it's roughly 4,002 to about 4,012. Just by remembering, show you guys, this is where that SPY hedge pressure and SPY open right here. Literally, we open right here. So 3995 to 4011 or 4012 is about a 17-point run with a 10-point stop. I come here and say, it's about a 2 to 1, 1.7 to 1. I trade to the next resistance. I put a stop right here. That's it. So those of you saying, what do the classes teach you? That's all 4 modules. It's just picking an entry, picking an exit, calculating risk and reward, and then the irrational rules tell me how big I'm going to trade, or if I'm going to trade at all. It might sound simple the way I do it, but I'm very rehearsed. I'm very quick, and I know what I want to do. I immediately know I'm going to trade small because it's irrational. I immediately know that I'm trading to the next resistance to call it. So my first trade is what I call my career trade, the one where everything lined up. Bull sign, bull sign, bull sign. Everything's great. Irrational means I just didn't YOLO the farm. I didn't go in with 10, 20, 50 contracts. I've just put what? How many I do? 4. Trade next resistance, get out. Now, if I'm going to make a second trade, I don't care about the second trades. I have to trade smaller on a second trade, smaller on a third trade, etc. 96%. Yeah, 96% chance probabilistically that rational markets, DD greater than 6, open bull zone, stay in bull zone. So a second trade would be if I want to take a gamble trade, would be like, okay, what's another idea? Well, if this falls to here today, hedge breaks are irrational, but if DD's strong and resilience stays strong, I might be willing to long again to next resistance. Tell me, class, what's the next resistance? So say if I put in 4 contracts here for a career trade, which is my first trade that I take that I think has the most highest probability. Get in, get out, call it a day. That way I'm not in the market for random catalysts to jolt me around. I get in and get out as fast as possible. Put my money out there, pull my fish back in, I'm done. First hedge pressure level from there to there. So I might take a tiny scalp, which is also 10 points, and arbitrarily, well, I don't want to have a 1-to-1 trade, so make sure my stop is right here. So I had 4 contracts for a career trade. Let me do, I don't know, 1 contract for a gamble trade. Something much smaller, right? 10. Normally I have a 10-point stop, but if it's a 10-point run, I need to make the trade less than 1-to-1. So let's make it 2-to-1 again. So yeah, I'm going to wait all day just to see if I bounce here and take a quick scalp to there. And again, call it a day. What you guys see me doing is just called day trading. I'm exploiting imbalances in the market, exploiting real supply and real demand. I'm getting in, I'm getting out, and I'm not betting on direction. That's the difference between me and the day trading you've learned. If you've learned day trading where your job is to bet direction, like where we end up at the end of the day, you're not really day trading. You're just short-term investing. If you care about the direction of a stock, you are investing. You are not a trader. A trader doesn't care where the stock ends up unless it gives them an entry somewhere. I'm not betting that this is a bull day. The guy said, well, you're wrong because of the FOMC. And I was like, yeah, it's probably could sell off. But all evidence shows it's going to rally right out the door. So whether it sells off or doesn't, I don't care. I'm already made my money. I'm already done. Right? Where does the red line come from? You don't have it on your chart. What event caused it? Oh, it's yesterday's FOMC buying tech. Good question. So Joel says, you got your first payoff from ETF today? Oh, that's dope. Good job. Good job. Congratulations. It's a big milestone. Matter the institutions using SPX. Yeah, they are using SPX, Brian. They're using a lot of stuff. Like, as a matter of fact, there's a whole thing where it says the entire notional value of SPX risk is locked up in 80% of notional value of SPX is locked up in 0-day options on a daily basis. 80%. Isn't that crazy? Now do you have daily options on these things, or weekly options that expire every day? All the videos of beginners are under the Rocket Scooter training tab. Absolutely, Suki. Yes. Thanks for the explanation. Okay, since liquidity maps print at the open, this effect of 0DT options mostly show up in resilience. You would, yes. Well, you would say that the options themselves will show up in the liquidity map. The liquidity map looks at all the options. So 0-day or expiring today SPY, this is all the options risk. So bull zone is not just options that expire today. We look at all options that exist in the SPY indefinitely. So all options risk is considered. For what we call daily mode, only looks at weekly options. Monthly mode is the same thing, but looks only at the monthly options. So let's look at what SPY looks like over the course of the month. I just click monthly mode. Over the course of the month, we're bullish, at least from today's options. There are bulls all the way from 375. You may say market is bearish because of fundamentals. Well, in the short term, yeah, maybe some risk shipped around. And today, the nearest, like, I guess the nearest risk change is 394 bullish. If I were to zoom out on a monthly scale to see what's going on, as we know, monthly expiration is going to be the 21st of April. What does it look like if I were to forecast to the 21st of April? This is what the 21st of April looks like when I click monthly. As you see, if we do break into short-term bearishness by breaking into the bear zone today and markets collapse, long-term bullish support is at 382.5. So as a swing trader, I know about how far I'm willing to be or where I want to put a stop or where I want to put options to hedge if I'm long the market. Say that I've been long SPY for like the last 6 months and now we get some bad news in the Fed and I go, oh man, I kind of want to hedge. I need to make sure this isn't turning into a bear market. Well, this is where you get bear structure below monthly hedge. So what this tells me, if I was like, ooh, you know what? If this Monday did this and Tuesday did this and Wednesday did this, you don't wake up and say, oh, I'm going to jump in on that short. You go, oh, thank God, there's that dip I wanted to buy. And my stop is literally right there. Or right now, let me buy some monthly puts here to hedge my long position because that's where it really flips shit and goes down. So in the longer term sense, the person that was saying this morning, FOMC is this, and I may be wrong on the trade, very possible, but it's not a bear market. Even if it does sell off, it's still bullish all the way down to 375. There are bulls lined up from here probably since October, still long the market. Since that market dipped, or at least people that want to be bull and want to buy the dip there. The market doesn't become bearish until you hit a bear zone, which is literally the bear is seen at 350 or lower to be ready to short this to the ground. So the market's very liquid. Bulls and bears agree somewhere in here of liquidity. Where markets are balanced. So clearly the markets are still very bullish for the month. Long-term bullish with support there till April 21st. And again, these numbers will change every morning, so you have to adjust and adapt. And today, bearishness today would include 393 and lower. So even though 393 and lower falls, That shorter term risk is all piled up right in here, probably from that FOMC. But longer term, as you see, even, or shorter term risk, there are even still bulls again at that same spot. It's only a little batch of bears over the last week or so that started overpowering with shorts right here. So ideally, you can say if you break into bearish zone on the short term and it falls through here, I'm ready to scoop back up inside of here. Right? I don't want to scoop up inside of here because it's got bear pressure. I will wait and wait and wait and wait and wait and buy my dips down in here where it's bullish and long hedging, right? So that's why I do fundamental analysis, click monthly, daily together, combine the two for a bigger look at the market. No, you're not wrong. That's the thing. You probably are right. That's the thing. It doesn't matter the direction. My point is that you're probably right. As a matter of fact, I'm hoping you're right. I'm hoping I got out of the way of you being right. I don't think the market has short-term bullishness at all. I think a lot of these bulls are, even though this is the positions they're in, that's really what Wall Street thinks, right? It doesn't matter what I think or what you think. Wall Street is bullish down to here right now. They are 100. These are their positions. These are people betting long, whether they're idiots. I've been, and you're the smart one, which is probably the case. They're just dumb. They're wrong and we're right. It doesn't matter. This is not somebody being right. This is somebody being long. And they could be wrong as well, right? This is just where Wall Street's positioned. And I'm just exploiting where bulls are. I don't care if they're right or wrong. I don't want to be right or wrong and pick the direction because I agree with you. I think short term we are bearish. I think all the data points suggest that while we might rally for a day or two on the hopes of rate cuts this year, I really think the economic data is going to be a little finicky with QT on the horizon, with banks failing, and with the idea that jolts are going up and continuing jobless claims are going up, which means there's jobs available and companies don't want to hire the people that need the jobs, which means those people that need the jobs probably are at risk of default. How many months later are they on their mortgage? That's going to put extra stress on the banks, and that's a looming, ticking time bomb waiting to happen. So even medium term, continuing rise and continuous unemployment or even new waves of layoffs while jolts are going up would be massively bad for the short term. Even if you were to think that people will get their jobs back, jolts mean available jobs open, and companies were to hire the people that need the jobs, the reason they're not hiring them is either labor mismatch, it's the wrong type of, like they're tech and you need an oil worker, I don't know. Or they want too much and you can't afford them. So you got to meet in the middle. Either way, if a company wants to pay $200,000 or $100,000 for the job, and the workers that are all unemployed want $200,000 for that job, it's kind of like a trade, right? The worker and company need to meet in the middle to get the job filled. So the company might just say, you know what, we'll pay more. We want to put in 100. You want to? How about 150? So now the company's going to pay a little bit more than they wanted. Therefore, the bottom line is lower. They have less money at the end of the day in their pockets. And that efficiency of that worker doesn't just kick off the day they get the job. 3 to 6 months for a worker to start really pulling their weight around a company really means short-term bearishness in the stocks, as the quarterly report would reflect, less cash flow at the end of the quarter. So either way, the job situation shows that companies are going to have to fork up a little bit more money to hire these employees if they need to fill those jobs, which brings stocks down, right? If I have to hire 50 people at a little bit more than I told my shareholders last quarter, then I'm going to have less money in my pocket. Now dividends will be smaller. Share values will come down. People will bet on that forward guidance, right? Forward guidance is the biggest driving force of stocks. So either way, the labor market's pointing at quarterly bearishness. It still is. Now, if we look at the monthlies, you can see it's bullish month to month, very, very, very low, which tells me that quarterly bearishness can manifest in the next week or so, somewhere down in here. The longer term bearishness, which I agree with you, Ivan, 100%. Shorter today, bullish, right? People are knee-jerk reacting to the FOMC's median. The members get together and vote on what they think is going to happen. Let's look at that median right here. This right here. This is why the market's bullish and it's a gap and go today. This right here, right out the door. Okay. FOMC participants of assessments of appropriate monetary policy, midpoint of target range or target level for the federal funds rate. Okay. the estimates of the midpoint here, right? We're at 5 right now, right? This is where we are. We're at 4, I think, what, 475 to 5, correct? In 2024, the median is lower. This is rate cuts. Y'all see that? This is cuts. Like at least median cut, right? The median would be lower. Now, granted, in the short term, a couple people forecast we get, and as we've been trending at 25 basis points before the end of the year, we could be at 5.5 or whatever. So about at a rate of 25 basis points per rate hike. If we are in the high end of the range of the estimates, how many more rate hikes will we have? Do the quick math. About how many rate hikes do you estimate before they go to 0? Right, my estimate they would go to 0 as early as March, but now I'm gonna change that forecast. You can see it right on this chart. How many more rate hikes are we gonna have? You can literally predict this. How many rate hikes are the Fed telling you at most will we see? Based on the average sentiment. No, not one. We've been doing 25 basis points a pop. You can see that we're here. 1, 2. So 5 to 5.5 at a rate of 25 a pop. So we're going a total of 5 more. So 5.5 rate from 5. So if you look at it, I'm talking about not the median, but the high. So best case scenario for a bull market is they just cut rates starting tomorrow. Worst case scenario is we go up to 5.5, give or take, from where we are now at 5. Right? Because that's the high end of the range. So worst case scenario, according to the Fed in 2024, we only go up another 50 basis points total. Most of them think we go down a point. Look at this. All of that is clustered down here. A huge majority of them think we go down 50. We go down 75. We go down a full point. And some of them think we go down almost 2 points, right? Only 2 people think we get rate hikes, and the rest of them think we stay flat or go down, right? This is their assessment of what they believe the appropriate monetary policy would be. So, as you see, the majority of the FOMC participants believe that we are flat to down going into 2024. A couple of them think we should go up. So the worst case scenario, let's look at this guy right here. The guy in the end of the room that really thinks you need to raise rates still. He's saying we need to go up another 50. And everyone else is like, nah, I don't think so. So if we usually get 25 points a hike and we're going to go up 50, that says at worst case scenario, 2 more FOMC decisions that go up. Worst case scenario. So this is March, April, May. By June, we're at 0. Worst case scenario. By June, do y'all understand how I just did that? By June, worst case scenario, we're flat in June. Best case scenario is we're cutting. So now I know the outlook on rates. Worst case scenario, it takes 2 months. So April. So if this guy is right and everybody listen to him, April is going to be 25. May is going to be 25. Can y'all see how this chart works? And June is 0. If we assume the biggest rate hike person is right, most people think we go down. This is where the median is. Y'all see that? Or that's where the cluster of people that believe the midpoint of target range or target level of federal funds rate. So if you just think of it like this, you can kind of make an assessment that most people are clustered, that the median range will be down here. Very few people think that the median range is up in here. Okay. So this is how you assess this. Worst case scenario, we got 2 more tiny hikes and Fed's going flat. But yields are completely being decimated in the bonds market. I thought they'd have to go aggressive, and maybe they will. But it looks like the Fed is committing to rate cuts as early as this year. Because as early as 2025. Again, this guy, whoever that guy is, still thinks we need to raise rates for 2 years. Everyone else thinks the highest participating member is telling you by 2025, it's lower than the current rate. So in all case scenario, by 2025, we're back to rate cuts in the worst, slowest case scenario there is. Y'all see that? So it doesn't look like we're going through any period of raising rates. And whether they're just publishing this to put some stability in the stock market, this is very bullish knee-jerk reaction right out the door. It's always bullard, right? But do y'all see how you can look at this and tell you the Fed is committing to a very slow rate cut? And why are they doing that? Well, either A, they care about Wall Street sentiment and actually really don't want to have these banks. They're like, yeah, the banks are making bad risk management choices and it's their fault, not our fault. I mean, you can say it's SBX's or SBF, whatever that guy's name is, his fault and his fraud that caused FTX to crash. But crypto crashing also caused all those things to fail, right? These people will be able to live long and prosper with their fraud all day long had crypto not collapsed, revealing that risk that they're sitting on. Had the stock market or inflation not run amok, and the federal funds rate had not been going up, it's the banks should have not been so over leveraged or heavy on their books on risky assets that were sensitive to Fed rate hikes. That just shows carelessness in their investing. Now, while that's the way the cookie crumbles, one may say, gosh, well, Bear Stearns would have collapsed if they weren't just over leveraged in mortgage-backed securities and the housing market collapsed. Well, had the housing market never collapsed because there was no such thing as adjustable rate mortgages, then Bear Stearns would still be here today, right? So in reality, yes, it is the Fed's fault that these banks collapsed, but the Fed is not to blame. The Fed just pulled the curtain and you saw the wizard had a stupid fucking exposure to assets that were sensitive to the Fed. That's not the Fed's fault. That's their gamble to take as a bank. That's their job as a trader to understand the sensitivity and exposure they have to the market and to the Fed rate hikes. And they just didn't care. And the banks collapsed. They were too exposed to things sensitive to what the Fed was doing. So in reality, had the Fed continued to cut rates, Credit Suisse would still be here. Silicon Valley still be here. They would still be rallying to the moon, right? The Fed has a bigger purpose, and it's to control inflation. If inflation outpasses bond yields, nobody wants to invest in the debt of the US government, which is what a treasury bond is. It pays a fixed yield. And if your fixed yield gets gobbled up, think Pac-Man, a little bit at a time every year, so at the end of its maturity, you've lost money because of inflation, then that bond market's going to tank. And nobody is going to want, and that lowers the strength of the country's ability to borrow money and expand its economy. The Fed has a greater purpose and responsibility than to, oh, sorry about the bank, you're overexposed. Fuck you. You bought crypto assets. You're an idiot. Oh, you had exposure to Web 3.0? Sorry. It's not bailing you out right now. We have to control the economy. Look at the bond market. It's been collapsing since COVID. That's not good for the dollar. It's not good for the strength of the country. It's not good for productivity in general. It makes it harder for us to borrow money or to have people buy our debt if the cost of the debt is expensive to hold it. The maturity pays no money because of inflation. We have to get that stuff under control. Yeah, they don't care because they'll always be safe. And what I think the Fed has to do is acknowledge the idea that that rapid testament of cutting rates, which is what you're seeing, has everything to do with the idea that the Fed is saying inflation's under control. Inflation will self-regulate at this point. And that was our thesis a long time ago. Inflation will self-regulate. Because it's strictly caused by the labor market right now. That's what's causing it. Inflation's not being caused by a credit bubble, Inflation's not being caused by a housing bubble. Those things bubbled because of shortages of stuff, shortages of labor, shortages of storage, shortages of transportation, shortages of raw materials. The shortages post-COVID caused the prices to go up. Not people just are so desperate to get a house, and it's easy to get a house. You don't even check your credit report like in 2005. You can get a house, adjust rate mortgage. Stay here. I know the rate is, teaser rate. Oh yeah, we'll give you, you have terrible credit. We'll give you 10% now, but it's going up to 30% later. I don't care. I need a house. Right? That's stupidity. And that caused a rush to buy houses, and the value of the houses went way up. The risk became even worse. That kind of quote unquote inflation of a price of something is from the overwhelming demand for that thing. This kind of inflation is based on the overwhelming shortage of those things, causing prices to go up. It is not the same environment. The Fed raising rates will immediately collapse inflation if it's caused by an overstimulated lending market, credit market. Fed raising rates dries up credit if it's available. It makes it more expensive to borrow money, so it's harder for banks to give it out, and banks will tighten their standards. In this environment, raising rates also causes the same effect, but the banks are already strict because asset values are high because of COVID shortages, not because everyone out there bought a house last summer. You got it? So Fed raising rates, it's not going to do much to inflation immediately. It'll circle back around by forcing the banks to not have to, or the banks will not have the ability to lessen their standards, which is the smart thing to do. The Fed did this to prevent the banks from forming another bubble. Because every one of you, when I was buying a house, and I love my realtor, she's so smart. We're looking around and she's like, yeah, housing prices have gone up 50, 60% in the area you're looking at. Where I live, it's all $1 million plus houses. Maybe during COVID, you were seeing them go for 1.4, 1.6, sometimes 2 million. And she thought it was still going up. The Fed immediately QT and raising rates popped that bubble very quick. If you guys remember watching that movie, The Big Short, remember when Brad Pitt and all of them go to that, I guess the brokers conference in Las Vegas. I think they were all like mortgage brokers, right? They go out there and they're like, wow, this is just sheer stupidity. These guys don't check credit reports. These guys give teaser rates and then triple the rate later. Yeah, and then when they go to refi, that was the problem. Nobody wanted to accept the refinance because nobody wanted that risk, right? Because the mortgage bonds were completely worthless. Nobody wanted to refinance you. You're about to default. No, thank you, right? And that's what caused it. So if the Fed raises rates, then it keeps that. It makes it harder to get credit. And right now, when everything doubled and tripled in value, people are getting loans for those houses. The Fed was like, nah, we're not going to have another housing bubble. And they stopped it in its tracks, didn't they? That's why this happened. We're going to announce QT right now. And we're going to start raising rates right now. We just had a global pandemic and the market's trading at all-time highs on a short squeeze, as we showed. That's why it rallied. Majority of that were shorts covering, and commitment traders will show you that. Even post-COVID, you can see it. Look at this. April 2021 all the way to December 2021. Stock market rallied 12%. That's 500 on 4,000. Even greater, actually greater than 12%. Actually, wait, hold on. Yeah, a whole lot greater. Like 20-something%. Off of what? This blue line, hedge funds. Short hedge funds having to cover and cover and cover and cover and cover. People that bet on COVID round 2 got squeezed for an entire year. A short squeeze causes an illiquid market, not people longing the market. As a matter of fact, people started selling the market, the green line, as early as June of 2021. Here, people can't get out of the stock market fast enough on the announcement of QT. The shorts are getting squeezed so hard, it still pressed the market up. Y'all see that? For 7 months, the market rallied on that short squeeze. This is your 200% on a house. This is your, you paid 3 times the value of something because of a shortage. It's like, that's that world. And now you get all these people locked into crazy high mortgages that could still continue to squeeze and squeeze and squeeze until the Fed said we need to stop the bubble before it forms. And it would have formed, right? Oh, hold on. I'm being invited to trade in space, to talk in space. So what I'm saying is the type of inflation we have now is based on there's shortages in high asset values. You can't have these overexposed banks that are exposed to crypto become exposed to a second housing bubble on top of that. You know what I'm saying? So obviously the Fed needed to just kick the stock market in the balls really quick. And the stock market goes down, forces companies to lay people off, and wages come down. That inflation tail. That inflation solves itself. QT raised rates a little bit, scares the stock market. And guess what? We triggered some layoffs. And guess what? Wages came down. Imagine that. All the Fed want to do is get some people fired. Because can you tell you what stupidity is? Say you made $100,000 a year in accountant. Hey, what's up? right, guys. Love y'all. Everyone, go to the Discord real quick. We're gonna call it a day. I have to do a trading psychology space right now. It's gonna be really, really cool. I want you guys to all tune into Twitter. I'm gonna retweet this. Click that link and join us. But go here. Click that button right there. Go to our Discord. Come check out Rockseer. $35 a month for 3 months. Check the extended trial. Learn everything we teach. You will go through our entire program in a 3-month period. Take your time. Absorb everything. It's risk management. You can leave our group and take it with you. Risk management is a mindset. It's a process. Set of rules. Things you can do. Keep yourself safe. Try to create rule-based system. All the stuff you want to accomplish. We hopefully can give you some knowledge to take with you. We're going to train the entire world in risk management. Like I said, $35 a month for $199 package. For 3 months. Check it out. Trust me, I waste $35 on the dumbest stuff all the time. This is going to be a really extensive education. We're glad to share it with you. Check out Rocket Scooter today. Everyone else is. Maybe you should check it out too. We love y'all. Have a good day.